which is part of the, I think, question for a lot of people in the academic audience is how much has their work influenced what you do, and more important...
I have to do something before we get there, okay?
Can I just finish and so you can ask it later, that's fine. But more importantly, how much you continue to use it in your day-to-day work.
And that is basically a big chunk of this discussion. And in fact, we're going to be getting to that just real soon here. Ramu, did you have a similar question or something?
Not a similar question. Okay. The magnitude of the drop in price of the share itself gives you some indication of the wealth loss, right, as a result of this misstatement, so to speak. Does that become like a floor for you in your estimation? You see what I'm saying?
So let me ask the following. When you do this calculation that involves what the value would have been had they reported the right numbers in the first place, to what extent do you calibrate that against the share price? It's usually a decline. The share price decline on the day the restatement is announced.
Right. Well, the models that's actually a separate exercise. It's not using one of the valuation models. And you might find that ultimately the valuation models indicate a larger decline than what you observe in the stock if you do more of an event study type approach and actually calculate on each disclosure date what happened. And then the answer of what you do depends on who you're working for. If you're working for the defense, you obviously stick hard to this is it. And that's kind of where it ends up.
So I understand the importance of Trevor Harris's question, so we're going to get right into some of that stuff now, because I'm going to turn to Matthew, whose job it is. This is his day-to-day job. Gets up in the morning, drives into the city from New Jersey and says, how can I come up with a trading rule today? Right. How do you do that?
It's not an easy, simple process, and I think everyone in this room appreciates that it's actually very hard to know where your ideas come from at any given point in time, and very hard to kind of especially describe that process in some coherent manner. But one thing that we certainly do is read the academic literature. The SSRN is, a very valuable source of new ideas for us, as well as, published articles that we may have never gotten around to testing or really appreciated. And just, a few examples of papers that we have found have been useful that you may or may not realize, and that some people in this room may not necessarily wish me to say that we use in our lives as trading strategy or coming up with trading strategies. One example is Binoche, Lee, and Tensley, the extreme returns work that Charles has done, where they really look at a kind of a two-stage estimation of what makes stocks more volatile, where we're going to have extreme winners and losers, and then using some contextual analysis on top of that to separate who was going to respond negatively versus who was going to respond positively, and using a whole series of accounting variables to help discriminate those, whether they are changes in gross margins based off of Lev and Thiagarajan, I believe, whether they are looking at some sort of Sloan's accruals measures, some version of that. That's just one kind of piece of our research. Sloan's accruals measure has obviously been a critical portion. I don't think there's any buy-side shop of any sophistication at this point that doesn't use one version or another of that research as a measure of quality, and we don't really care so much about the definitions of quality. We think we kind of see it and know it. And they'll use some version of that. One of the problems that we have with some of the accounting literature that is done, and when you actually go to implement it, is, for example, in that piece of work, they just exclude financials from it, and they exclude, REITs and ADRs. In our world, just, especially if you're coming up with cross-sectional signals, excluding 25% of the S&P right off the bat isn't really useful. Or you have to certainly worry about how you're going to come up with some sort of cross-sectional signal for those kind of companies. So One example of another piece of research that we use is some of the work that Michelle Hanlon and others have done on looking at large changes in book to versus tax numbers. And we'll go and try and see if some of that isn't more applicable in financials. One of the other big topics that many people use and that I spent a period of my life working on was the analyst forecast literature and the revisions literature. And we are certainly, many of us on the buy side and quantitative folks are very much aware of the large accounting literature that has gone on there. And, be it, Walthers and McHale and Willis' work or Clement's work or there's just Larry Brown's work. I certainly don't want to offend anyone by leaving out the very voluminous work here on how do you kind of come up with...
These are academics, Matthew.
So I probably am offending them by not mentioning their work. Not my intent. And trying to understand where the biases are, where the sources of, forecast error are, the accuracy. Those are certainly, large portions of literature. I could go on for a long time.
But I'm going to interrupt you and ask you a couple of pointed questions, and I'm going to go back to David and Roger and ask them some questions about research. The first question I want to ask is something that came up in this conference, and it was a statement that I attribute to Larry Brown and Mark Bradshaw, who said that quants, you're a quant, place a lot of emphasis on earnings surprises. Is that true?
Not anymore.
And why, you said not anymore. Tell us more about the not anymore side of these trading rule strategies.
Well, one thing that we certainly worry a lot about is the sustainability and the time dependence and persistence of these trading strategies. And it's one of the most complicated and difficult tasks that we have to figure out is what you're observing actually signal or noise and how you discriminate against them. And how you begin to, pick out whether something is, none of the trading strategies are money machines. We're very much aware of that. Nothing works 100% of the time, and those strategies, if they do work, certainly get arbitraged away very, very quickly. Sharp ratios of 2 don't persist. And so what we try to do is develop some sort of learning models, either very formally or informally, and trying to understand how quickly things disappear. I think there is a good debate about whether, among practitioners at this point, about whether earnings revisions models have, that has just been arbitraged away. Is it just because of a general failure of momentum strategies and trend chasing strategies in general, why you haven't seen them work over the past 5 to 6 years? Or we can, Reg FD, there's certainly numerous explanations and studies, internal studies that we have done about that. Earnings surprises, I don't think that there is much contention among practitioners that they just don't work at this point. I don't really think anybody uses them in their models at this point.
You don't know why they don't work. They just don't work.
Well, I mean, that could be part of the problem of how you actually begin to measure expected. So, obviously there have been a lot of people who have looked at trying to come up with different definitions of expected, whether you're using some sort of seasonal random walk, whether you're going to use some trend extrapolation, whether you might even just use the relative magnitude of response on the day of the earnings announcement and use that as a discriminatory variable. In general, no matter what you do, they don't really seem to be working.
Larry Brown, to whom I attributed this statement, has a comment, and I can hear you and I'll repeat what you say.
I was just curious as to whether the refinements of let's say, a surprise strategy have been looked at in the context of how much of the surprise is due to a cash flow surprise versus an accrual surprise.
So the question then is, if earnings surprises don't work anymore, would it be possible to separate the earnings surprise into the cash flow piece of the earnings and the accruals piece of the earnings and see if there's still a piece of a trading strategy there?
The way I'll try and answer that is, despite the relatively widespread application of the kind of accruals anomaly that many of us seem to be aware of, that does seem still to be working. So To the extent then perhaps that you can break down surprise from one versus the other, you might be able to get more of it. But really, in general, surprises, as far as we know them, and as far as the clients that I have talked to and are willing to share with us, don't really seem to be working, no matter how you begin to slice it.
Now I'm going to go to Roger and David with some questions on research, but first, Trevor. Okay, so earlier, yesterday, Jeff Abarbanel posed the question he'd really like to know about the extent to which these valuation models that we, people who are professors, teach their students and talk about and develop, whether those things actually get used as valuation models in valuation exercises like the kind you do, where you're valuing a whole enterprise or valuing a reporting unit for goodwill impairment or valuing an intangible as part of a business combination. To what extent do you use the academic research on valuation?
Well, when I was packing to come here, I
Look
went
at this thing he brought.
to my stack. This, other than the, this is statement 15X for fair value. This is so Catherine wouldn't get on me that I wasn't up to date. And these were the articles and SSRN working papers that I've accumulated and read over the last 3 to 4 months in the accounting literature. I have another stack in the finance literature.
Well, I read that stuff too, but I want to know how much you use it.
Well, this one, I used implied equity. By the way, I'm reading this to find a nugget. Okay? Oftentimes, and you may not even know the nugget that I've extracted out of it. But for example, implied equity duration, a new measure of equity security risk, Dechow, Sloan, and Solomon. I was talking to Mark last night. He didn't know. I used this, the adjustment to cost of capital based on something that's in here, in a tax court case, a U.S. tax court case that I testified in December. So it had to do the duration of cash flow and how that impacted the differences between enterprises relative to their cost of capital. And to me, in that case, that may not be the reason we win or lose that case, but that's where I extracted it from. And in fact, I carry around, this version, June 2001. And I've used this again and again and again, the method, little nugget of methodology that's embodied in here.
So I'm going to use what may be viewed as a fairly colorful and even a pejorative characterization. So you troll about through the published and unpublished accounting and finance literatures looking for something that will facilitate your professional assignment.
Yes.
You extract that and use it.
Yes, I do.
And it would appear
with the attribution, you're footnoted. The judge has a copy of the article, by the way.
And I would assume that the cumulative effect of this over the number of years that you've been in the business has been significant in shaping your thinking.
Yes, I do things differently today. I look at things differently today. I teach young staff differently today than I would have years ago. And, I still tell people, for example, I still tell staff, the most important course I ever had when I was undergraduate that I still use today was cost accounting. And why? Because I understand the flows upon which all of what I deal with day to day is dependent on the largest expense number in most income statements, the cost of goods sold.
Would you say that you are a typical valuation person, so that if we were to sample randomly from the American Appraisal Institute, we would find more people who say what you say, that they study the accounting and finance literatures to find things, nuggets, that will assist them in their professional assignments, or would you say that you are atypical?
I'm probably atypical, but I also get the biggest assignments, so that's...
A successful atypical. So, yes, Ramu?
It depends on where you play the game. I happen to have the luxury of played the game with very good clients, with big dollar issues, with big companies over the years. When I do a restructuring for a major company, for example, and a lot of the issues of we're valuing foreign subsidiaries and moving ownerships around and forming joint ventures with other entities, et cetera, every one of those, I was just in New Jersey last week, we're discussing one where the trying to work out the costs, and we're talking a company with $30 billion in revenues. So there's big dollar items. They're willing to, spend money understanding what are the drivers of value.
Okay. Now, I know that both Trevor and Ramu want to say something. And does one of you want to cede to the other one? Okay.
Just want to get some perspective on Baruch's comment earlier. You've used valuation models for a long period of time in different contexts, but the inputs to the valuation model from an accounting viewpoint has changed. And one of the objectives of the FASB is to make those inputs better for purposes like yours. What's your thought on the impact of the accounting standards and what they've done to the accounting numbers to you?
Well, actually, you can ask all three of those.
Yeah.
The same
I
question.
certainly want to say something about that
Okay.
as well.
What
we'll
has
just-
happened to the input? The inputs have changed, right? I mean, there is more market accounting. Options have now come into the financial statements. So what's your feel on the change in the inputs to in the way they impact the way your valuation, the way you look at it? How is that?
I still want disclosure because even though under all circumstances, I want to try to understand why the numbers are what they are. And so even, for example, in fair value, where you end up with a fair value on the balance sheet. Fair value is a combination of operating income and it's a change in asset pricing. There's two elements that occur every time fair value is put on the balance sheet. To me, that component difference is very critical. So I like to see the disclosure about the components of that. Now, part of the reason I follow the literature is because of the change in the impacts of financial accounting on how people assess basically the capital markets. So you have to keep up with that.
David, I know you're not an accountant, you're a finance guy, and so maybe you don't actually know that the generally accepted accounting principles keep changing. But is that something that's of concern to you? And if it isn't, we can just pass right on to Matthew.
Well, I think we'd like to understand the changes and what's reported and what's not. But ultimately, as long as we can understand what's going behind the numbers, we're probably happy with it. And so more disclosure is typically better for us, so we can at least get a sense of how things are impacted, what changes.
Your restatement assignments would seem to me to be kind of neutral with respect to accounting changes. But you also do these capital structure solvency analyses. And because generally accepted accounting principles keep changing, tinkering around with the right-hand side of the balance sheet, that's a problem for you, right?
It's a little bit.
First it's on the balance sheet, then it's off, then it's back on.
Yeah, it's a little bit of a problem. Though I think ultimately in those solvency analyses, what we want to do is step away from the GAAP requirement and look more at the economics of the situation and see how is the firm capitalized, what are their true obligations, and do they look like they're going to fail despite whatever issues are in the case. That the other side would say, well, if it weren't for this, they wouldn't have failed. So we kind of want to step away from the GAAP reporting a little bit.
Now, I know that Matthew, who deals in his business with these long time series, big databases, you are at the mercy of what's going on with the commercial vendors, right, what they put in and how they put it in. And you're also, you're at the mercy of the standard setter who keeps intervening in the series. Right?
Yep.
So aside from wanting to just make all this stop, or maybe you don't, how do you deal with that?
We don't. I mean, in some levels, we don't want to make it stop, but on some levels, it is a very frustrating series occurrence for us when they happen. Just for example, if you were trading an earnings revision strategy and the new options expense change happened, you have a major problem when people start necessarily taking down their earnings revisions, their earnings numbers, and are they taking them down? And if you're, again, we're in general, and most of the people that I deal with are playing these games not over individual companies, but we're thinking about implementing them for very large universes. So playing it on the S&P 500, playing it on the Russell 3000. And so, and where quantitative techniques really have their most power is really when you begin to use the hit rate associated with them. So it's not that you just want to play it on a long 50, short 50. You really want to kind of take as big as universe, a quintile as you can, to go long the positive revisions and short the negative revisions. To the extent that you can't understand why something is being revised upwards or downwards, is it because of the change in accounting standards that now people are putting in options numbers, and maybe all analysts aren't doing it at the exact same date, you have a major problem and then beginning to understand whether you're getting any signal here or just noise because of the accounting change. And, you know, people have developed various strategies to begin to deal with this. Some people actually go through and keep count and call the individual analysts for each of the individual companies and figure out what is going on in a very complicated, tedious, laborious way. And then, you know, kind of just deal with it as that happens, and may even track those and keep those changes going for years and years and years in their data sets. I would call that relatively unique. But there are some of our sophisticated clients who do that. And then if you're just having general changes to book value and how book value is being computed, and you just want to go and determine the efficacy of a price to book measure, when you have these major changes and disconnects in how book value is being computed, again, you have a major hurdle of whether you're going to be continuing to run, you know, putting everything on an apples-to-apples basis or not. One thing that one of our clients has also discovered that is rather disconcerting and is that they went and did this when the goodwill change came through on how you're dealing with earnings numbers. And they tracked for the Russell 1000 and went and put everything for their earnings revisions numbers on an apples-to-apples basis, make sure that all the analysts were treating everything equivalently. And then they tracked how that corrected measure did versus the naive measure of just taking what the analysts are doing, using that regardless. And they found that the naive measure worked much more effectively. And that seemed to be what the market was actually using than using the corrected version. And so then it becomes a whole big question of do you want to untangle this and put it on the right version, or are you outsmarting the market by doing something like that, which is a very disconcerting thought.
So what I hear our three panelists saying about these changes in GAAP is that Roger doesn't care as long as he knows what it is. Mm-hmm. Right? David doesn't care as long as he knows what it is and can potentially make adjustments. And Matthew certainly knows what it is, but because he uses the big commercial data vendors that don't put the numbers in the notes in, right? They don't put the numbers in the notes in. All you get is the numbers off the face of the financial statement for the most part. Anytime the FASB moves something from the notes to the financial statements, the information was already there, it just wasn't in your database, and you get a big discontinuity.
Yep.
Not a good thing.
Not a good thing.
From the product development perspective.
I mean, it can be a good thing, right, because we may actually now have more information to deal with, but short term it can certainly be a problem.
Mm-hmm. Now, I didn't get to the point where I was able to ask David Marcus how he uses academic research in his professional practice. And the way that you were talking indicates to me that you use it a lot because you said things like event studies and valuation exercises. Do you have a folder like that brown thing that Roger has?
It would be more like a bookcase.
Okay.
Academic research is critical to virtually everything we do. And the main, if you think about the big picture, we're involved in litigation. We're going to have an expert walk into the courtroom and testify on how some actions affected a company's stock price.
Are those experts who walk in often academics?
Generally academics.
Generally
yes.
academics? Are they people who are research experts in that area?
Typically, yeah. So there'd be people like you in this room who would come into court and testify on a situation. it's always a stronger position to take that you followed some generally accepted practice in the industry rather than, well, I made up my own valuation model for this particular case. That tends to be judged poorly in the courtroom. So we want to use something that's standard practice, but also we want to be able to use what's the best method, because ultimately we want to have the best argument to support our case and make the other side look like their argument's not as
How
good.
do you know if this academic research that you're using to get these good methods is any good? I mean, you read this stuff. Here's a valuation model. The author of the paper clearly thinks it's good. It's published in some reputable journal.
Right.
Is that good enough for you?
I think it would have to be something that's been around a little bit and maybe cited, reference that people have built upon. And of course, the ultimate judge would be the expert himself, who has to be comfortable with that model and be able to say, yes, I'll use this.
But Cornerstone doesn't actually have a little research vetting shop where you go through these things and determine whether this is a good model or a bad model.
Well, I mean, nothing specific like that, but we do talk amongst ourselves about the different models that we use and share them amongst ourselves and see what seems to be the types of models that work well and are accepted.
So, yes, Trevor?
Catherine, the question I've been wanting to ask
For which of these three?
to you is, you are also someone who, for the last 4 or 5 years, with some of your colleagues, arguably as a user of research and a lot of the work that's get done. If you look at some of the topics like forecasting and earnings quality and so on, it would seem that that would be potentially relevant for the standard setters. And they sort of seem, as Baruch was saying, that should be one of the constituents that uses the product of the people here. So my question is really twofold. One, I know you use it, but the rest of your colleagues and also the other standard setters you've come in contact with, do you use it? If yes, how? And more importantly, my question is, given the stated conceptual foundation of wanting to predict something, is there anything that researchers can do to help the standard setters work towards the outcomes better than maybe, or differently to the way they're doing it right now?
Sorry, guys, I'm going to answer this, okay? The FASB doesn't actually think about things the way some have characterized financial reporting and standard setting. For example, at the FASB, it is not true that standard setters think that the purpose of the income statement is to display net income. They don't think that at all. They think the purpose of the income statement is to display the line items that make up net income. And the big dispute now that's raging is over how to determine how to recast those line items to make that display more informative. So very few people at the FASB would recognize some of the research questions because most FASB board members don't think very much about bottom line earnings. They think of it as a way station on the way to comprehensive income and worry a great deal about the fact that we have no conceptual basis for drawing the line where we do that separates earnings from comprehensive income. That bin called other comprehensive income is not a good bin at this point. And worry a great deal about line item display and whether it would be appropriate, for example, to separate initial measurements from remeasurements on the income statement. If you go to a typical standard setter, he wouldn't say what I'm saying, but he would mean this. If all you want is bottom line net income, you need 2 balance sheets and some information about dividends, transactions with owners. So the whole point of this income statement is to display the changes in net assets from sources other than transactions with owners in the most decision-useful way possible. Now, what kind of research can be helpful? In some cases, it's very helpful to have behavioral experiments that require a judgment or a decision on the part of a practicing professional analyst. because those things are actually easy to explain to a bunch of people who don't know social science research methods. And they also tend to give evidence on behaviors. Other things that are informative are what Roger calls these nuggets, because the FASB staff will troll through the literature looking for a result that sheds light on a standard-setting issue. No question about it. Does the FASB use research in the way that it is often written and marketed? You know they don't. You know they don't. Should they? That's an arguable issue. I'm sorry, I don't see the person.
It's Jeff.
Thank you for your enthusiasm.
You all laugh, but keep in mind that he's the person who's working hard to formulate the questions to get the information that all of you can then use. Jeff, which panelist is your?
Actually, I've got a question for all of them, but I'm only going to ask one. Matthew, could you talk a little bit, especially the people who have done trading strategy work in academics, how you go about the task of back testing to decide whether or not you're going to implement some things, and what you find that is left out of the research that becomes important to you when deciding how much you want to rely on these things, and the kinds of things you find that fail in back testing?
Sure. And he's fully prepped on that too, because he told me that frequently he can find an idea that some academic publishes and the darn thing doesn't work. Yeah. In other words, you can make it work on the data that you got off the tapes, but it won't work when you put money on the line, right? How do you know that?
It's a big issue. I think that one of our frustrations of people who develop trading strategies or quants is that there's a general feeling that if you just control for size and book to market, that you have sufficiently controlled for size effects and style effects, where that just really isn't the case. And so one of the things that and there is very little work in the academic literature to really understand the time variation in the strategies and how pronounced those are and how much risk anyone would really take while these things fail for a period of 4 years. No one in the real world, none of us quants, would have the stomach for that. There is some limits to arbitrage in that way that are definitely out there. And so one of the big...
So let me stop just a second. So one of the things you do is try to ascertain whether the thing works most of the time. Mm-hmm. And if it works 12 out of 16 years, that might not be good enough if the 4 years that it doesn't work are contiguous.
That would be a problem. You might really think long and hard about that. I mean, if it just failed in the bubble periods, you might be a little bit more willing to accept that. But if there are sustained periods where it underperforms and sustained periods where it does outperforms, you'll be much more nervous about it. You want it to be much more consistent. We look a lot about hit rates. Are you actually improving stock selection, for example, or are you just picking off a few stocks where it happens to work in? That would not be particularly useful for a lot of the work that we do. So and a lot of our clients do.
That would mean that if all the returns, and they're huge, are coming from a narrow slice, so you're getting 2,000% returns on 5 stocks, and everything else here is at 2 basis points below the S&P 500, that's not a good strategy.
In general, not. I mean, you might. We would be less inclined to use it.
So you want pervasiveness.
You want pervasiveness, at least for the general cross-sectional analysis. You might be willing to, if you could identify those companies where it was working on and reliably on that 2,000%, that might be good enough. But if you can't come up with an understanding of where those few companies are, that is tough to begin to implement. I mean, we do things so simple as simply Windsorizing our returns. Our dependent variable to make sure again that you're not taking into account just extreme outliers. I don't know many academic studies that would do that. Again, so that you're really kind of fitting you're not just kind of fitting the endpoints of the distribution of returns.
How about implementability? Suppose that I've got a trading rule. You and I talked about this, and the return is huge on the short side, and it's all coming from the smallest 20% in terms of size of the New York Stock Exchange. Can you make any money on that?
That's a very leading question.
Yeah.
Obviously the answer is no.
You can't.
And so, one of the things that, we at Bernstein are going to be writing a research piece on when I get back to the office on Monday is this whole issue of reversal. That is, I think, one of the most pervasive effects and momentum that people know about and is really, in many ways, been considered gospel by most quants as well as most academics. And if you actually go and start to look at this reversal phenomenon, 1-month returns that reverse as opposed to the kind of 12-month returns, it is really only in the data for the smallest stocks we find. You have to get down below the bottom 10% of market cap. And so you will not find many people who will really be that interested in using reversal in their models. I think that, again, if it's not in the top 1,500, top 2,000 stocks, it's a very, very hard strategy to begin to implement. But most academic literature, right, just goes off the crisp universe without really beginning to think about how truly implementable these things are.
Oh, Jim Whalen.
Could I ask a question to Mr. Grabowski? Could you tell us a little bit more about how you assess risk and discount rates in the private company valuations and asset valuations that you do?
Did everyone hear that? It's a question about you're in a private company setting, you're doing enterprise valuation, you got to come up with a discount rate. Where do you get it?
Well, because my business has been private companies for so long, and the issue that most of the literature, and this is the finance literature, principally has dealt with, is measuring risks by market data, where I don't have market data. We went back to 1990. I went to CRISP, and we contracted with CRISP to build a CompuStat CRISP cross-sectional database. And we actually publish studies since then on accounting measures of risk and return. So that I actually use one of the most sensitive measures of risks are operating margin, and there's actually a high correlation of operating margin with actual returns, and also variability of operating margin. So those are two accounting measures of risk that I use in assessing the private company relative to as if it were public. Using accounting measures, what kind of rate of return would I expect?
So let me understand this. You've identified some instruments for discount rates, and then those are accounting instruments for discount rates, and you calibrate those against places where you have required returns in the stock market. And you say, okay, this operating margin number works pretty well because it captures 57% of the cross-sectional variability in these rates of returns for this size portfolio.
Yes.
I'm going to use that as the instrument.
Yes,
Okay.
and I use multiple measures because the last thing I do is hang my hat on any one measure. Okay, so I use multiple measures. Another one, by the way, it's useful is size. Now, in the academic literature, size, fama, French, go through academic literature is size is measured by stock price. I don't have stock price. And then you have Jonathan Burke saying, well, size really is, the low stock price is risk measure. I've actually found when you go to accounting measures of size.
Like assets or sales?
Assets, sales, net income, EBITDA, that there is a difference over time in the returns that the market actually has rewarded companies based on, they view size as a risk measure.
Is that study that you're talking about on the risk premiums, is that publicly available?
Yes, I actually publish it on the Ibbotson website. It's on the Cost of Capital Center that Roger Ibbotson has on his website.
And it's a study on equity risk premiums using accounting data?
Yes.
Okay. We're almost out of time here, and I'm going to give David Marcus the last word if he wants it. Does he want it? Anyone
Any
can have the
questions?
last word. Which panelist would like to have the last word?
Well, I just want to say thank you very much to Peter for inviting us up here for this. This has been very informative, and I want to thank you very much for some of the interchanges that we've had in the sessions, and in the dinners and drinking the peach wine that we had last night.
Thanks to the panelists and thanks to all of you.